Good morning. I'm Karl Kaufman, and this is the Morning Market Minute for Wednesday, June 1st. Behold, the fool saith, Put not all thine eggs in the one basket, which is but a matter of saying, Scatter your money and your attention. But the wise man saith, Put all your eggs in the one basket, and watch that basket. Mark Twain. Conventional wisdom dictates that diversification is essential to long-term investing success. You're often told to spread your money across various stocks or asset classes to protect yourself from risk. However, some of the best investors believe in the virtues of holding concentrated positions. Diversification is a protection against ignorance, according to Warren Buffett. It makes very little sense for those who know what they're doing. Do you have time to track dozens of companies in your portfolio and give them the attention they need? The average person doesn't have the resources to follow a broad spectrum of stocks in various industries or asset classes. William J. O'Neill wrote in his classic book, How to Make Money in Stocks, the winning investor's objective should be to have one or two big winners rather than dozens of very small profits. If you spread yourself too thin, you'll compromise your results and your likelihood of beating the market. Many financial writers preach the value of index investing. Just buy the whole market and be happy with being average. That's fine if you're aiming for average returns and don't want to bother trying to beat the market. It's unlikely you'll be able to accumulate serious wealth by utilizing that strategy. No hospital wings or college dormitories have ever been named by an indexer, said James Ohlschlager, founder of Oak Associates. They've been named by people who invested in one or two stocks and rode them for a period of time. Of course, selecting stocks for a concentrated portfolio requires a lot of analysis and attention. An investor with a concentrated portfolio must put the work in. They should listen in on earnings conference calls, study financials, and carefully track the business environment. The determining trait of the enterprising investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average, Buffett's mentor Benjamin Graham wrote in The Intelligent Investor. Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort in the form of a better average return than that realized by the passive investor. The biggest argument for diversification is protection from risk. By buying many stocks, you're indeed lowering the risk that any one stock would fall and wipe out a big chunk of your portfolio. But you're still not protected from overall market risk when the whole market tumbles. One strategy is to buy a select few stocks in uncorrelated sectors. For instance, you can buy a technology stock and balance that with some consumer staples companies to counterbalance a high-risk sector with a more defensive one. You can create sizable positions by buying incremental amounts in a smaller portfolio while ensuring you're not spending all your cash at peak prices. You can continue to add to these positions when there is weakness and improve your overall cost basis and returns. Buffett loves when the market drops, as he can buy more stock of the companies he loves at lower prices. Forbes interviewed Buffett during the 1974 bear market and asked him how he felt. Buffett's response? Like an oversexed guy in a whorehouse. If you have a financial advisor or money manager who is a fiduciary, and you should, they will most likely be unable to set up a concentrated portfolio. Fiduciaries are legally required to act in what they believe to be in the best interest of their clients. You'd be hard-pressed to find one who would set up a highly concentrated portfolio, since it runs counter to conventional thinking. You'll have to develop these skills and employ the strategy yourself. This method of investing is not for the set-it-and-forget-it type of investor. Those unwilling to analyze a company thoroughly should probably stick to index funds. However, if you are willing to put the work in, you may be richly rewarded for your endeavor. Better to be like the wise man. Put your eggs in one basket and watch that basket. I'm Karl Kaufman, and I hope you have a profitable day.